I know there's a lot of noise about recession. A lot of that was priced in back in 2022 from the forward-looking indicators. What we've got is the cyclical elements of the economy, car sales and stuff that are slow, miners and stuff that are driven by the business cycle. The business cycle is still chopping. Now, people say, yeah, but look, it rolled down. Yes, it did roll down. It happens at every low of every cycle. You tend to have this correction, and that's where we are now.
Raoul Pal begins by addressing the ongoing concerns about a recession, highlighting that much of this fear was already priced into the markets back in 2022. He notes that the cyclical elements of the economy, such as car sales and other indicators tied to the business cycle, are currently at a low point. However, this is typical behavior at the bottom of a cycle. Historically, we often see a correction before the economy begins to recover, which is the phase we are likely in now. He emphasizes that while there may be noise about a potential recession, the broader business cycle is actually bottoming out rather than peaking. This phase, where the economy is relatively slow, is setting the stage for future rate cuts. These cuts are increasingly anticipated as unemployment has been rising and inflation has been falling, both key signals for the Federal Reserve to start easing monetary policy. Raoul points out that the market has already begun to price in these rate cuts, reflecting an expectation that the Fed will change its course soon. Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
Now, the business cycle, remember I said, well, the business cycle is bottoming and not peaking. I know there's a lot of noise about recession. A lot of that was priced in back in 2022 from the forward-looking indicators. What we've got is the cyclical elements of the economy, car sales and stuff that are slow, miners and stuff that are driven by the business cycle. The business cycle is still chopping. Now, people say, yeah, but look, it rolled down. Yes, it did roll down. It happens at every low of every cycle. You tend to have this correction, and that's where we are now. So you can see the last 2 decades worth, you get this secondary dip before you get the recovery. So that's where I think we are now. It's kind of noise because most of the markets I concentrate on, crypto and technology, are priced off liquidity conditions and financial conditions. But we are at the relatively slow point of the economy where rate cuts are now kind of preordained, and the things that back it up are things like unemployment. I've been talking for a while that unemployment should rise. I don't think it's going to go super crazy, but now we're at the point where we're beyond the unemployment rate of the most negative Fed member. So obviously the signal is there to cut rates, and the Fed have made that clear. Maybe they come sooner, maybe they don't, maybe they inject liquidity in different ways. But either way, unemployment has been rising, and that is a key factor for the Fed, and inflation has been falling, which is the key factor for the Fed. So it's green lights all round to cut rates, and cut rates allows liquidity to come into the system. So what happened is this mix of the DXY, which is the dollar, and the 10-year bond yields, and Fed rate cuts all came from the Fed starting to suddenly say, well, the market's starting to realize the Fed were going to change course, and then the Fed changing course by saying they were probably going to cut at the next meeting. And that set this whole thing off. Now, there's a lot of rate cuts priced in. They weren't priced in before, but I think they're more correct in how they're pricing things in. Will it work exactly how the markets are suggesting? I don't know, but I think rates come down to 2.5% or lower in this cycle. If you remember, the everything code needs low rates because you have to refi the $10 trillion of debt. So you need low rates to do that and liquidity to pay the interest payments on the prior cycle's debt, which is why the everything code is so important in this and why we keep repeating the same old cycle. It's because it's about paying the refinancing costs of the debt, and we're deep into the refi cycle. So I've been explaining for a while, The Fed and all the central banks need low rates. The Treasury needs liquidity within which to roll that and also to monetize the previous interest payments. That monetization of interest payments is what drives the liquidity cycle and the debasement cycle, which drives up assets. Also, as the business cycle bottoms, people have more money, businesses have more money, gets reinvested, people invest more, and that builds on a cycle. Things like emerging markets do well when the dollar weakens. So therefore, profits get reinvested in the system, and the virtuous cycle of macro summer and macro fall play out. And that should play out all the way into the end of 2025. Okay, financial conditions are really important. So financial conditions lead the ISM, the business cycle, by 9 months. So we've been ripping higher in financial conditions for a while now, with some pauses en route. If you look at the current pause in the ISM, it matches the pause we had in financial conditions 9 months ago. But now it's been going higher. This financial conditions index doesn't take into account the fall in yields that happened this morning and the fall in the dollar. So by the end of the week, if those stick, we should see this even higher. But overall, as the dollar weakens and rates come down, financial conditions will continue to ease, and that will continue to lead the business cycle 9 months from now. Also, what the financial conditions is really gives you a composite of all the countries with their leading indicators rising. So it leads somewhat, and it's telling you that economic recovery is on the cards. And that's what these OECD composite leading indicators are. They're showing you that global economy is recovering and financial conditions is what causes it to recover, which is important because that's where profits come from. That's where earnings come from in corporations. That's where household earnings comes from. That's where investment comes from. Money goes into the stock market. All of those things are driven by this business cycle.
Raoul emphasizes the importance of global dynamics in shaping the economic outlook. He discusses the role of the People's Bank of China (PBOC) and its cyclical pattern of injecting liquidity into the system, particularly in the second half of the year. This liquidity injection is crucial not only for China, but for the global economy, as many economies are interconnected and rely on China's economic performance. He explains that the PBOC's actions are part of a larger cycle, much like in 2020, where they had to deal with debt deflation issues at home. Raoul predicts that the PBOC will implement quantitative easing and other liquidity measures to stimulate their economy, which in turn will support the global economy. He stresses that without China's participation, the global economy would face significant challenges, highlighting the interconnected nature of modern economies.
Okay, when we look at the global liquidity, you hear about me talk about global liquidity a lot. Well, you see, financial conditions lead it. The central banks pretty much act on the financial conditions. So there's a 5-month lead. So you can see financial conditions on this weekly basis have been chopping around a bit, but are moving higher. And that should mean global liquidity should follow. And financial conditions should be breaking out once the numbers are updated. And that will have the liquidity also rising. So liquidity is the prerequisite for markets to rise. And so that is all coming into the play. And now we've been given the reason. You know, people say, well, we need something to break. Well, guess what? We had it today. So we've got that. So global liquidity, when I look at it, global liquidity is about to break out too. I know you might think of this as a sin, doing technical analysis on the global liquidity index, but hey, it just shows the sideways contraction in global liquidity and the likelihood that it plays out, driven by the US, driven by Japan, driven by China, and also eventually driven by the Europeans and everybody else, because they all need to refi their debts. That's the big game, the everything code game. And global liquidity drives crypto. So if global liquidity is going to break higher, crypto will too. So if you've got to think of these moves that we're seeing currently as wiggles on the path of the main trend. And what you tend to do, it tends to overextend in bull markets, and we should see that in due course. So as global liquidity rises, cryptocurrencies will rise, as will other markets like NASDAQ. The other thing is global M2. Global M2, many of you have pointed out, is starting to rise. It's starting to break out. As that breaks out, that's led by financial conditions. So global M2 is rising, another liquidity measure. Global liquidity is going to rise. Financial conditions are going to rise. Okay, this is what we're looking to see. This is the macro summer signature, the macro full signature, the times when debasement comes, the times when assets do really well. You can see Bitcoin, how sensitive it is to global M2. As global M2 starts picking up, Bitcoin year on year should start picking up too. So again, I don't see anything concerning in the macro picture. The macro picture is incredibly supportive of higher asset prices. So that's why I think we're dealing with a spasm and not a regime change in macro, where we're going into a recession or something like that. In fact, it's the fears at the bottom of the cycle that's causing this. As the cycle starts to rise and things like the dollar needs to start weakening, it's not fears the other way around that the cycle's about to fall apart. You can see the financial conditions index also affects S&P 500. Equities are driven by financial conditions. So there's a 6-month lead here. So as financial conditions start easing, that's the number going up, the S&P 500 should follow suit. So again, we expect to see stronger equity markets ahead. Emerging markets, they're driven by financial conditions, 6-month lead. Emerging markets really a function of the dollar, which is part of the financial conditions index. Financial conditions, our measurement is the dollar plus rates plus commodity prices. And we're seeing those ease, and that should put emerging markets higher over time for those of you who trade them. Tech stocks, 6-month lead, same thing. Tech stocks have been correcting and had obviously overshot financial conditions somewhat. And again, we should be looking for a base over this period of time. This volatility, for those of you who aren't kind of max allocated to this stuff, this is the opportunity you're really going to want, because NASDAQ again should take off from here around these kind of levels. Now, again, I'm not talking about today or tomorrow. I'm talking about over the next 3 or 4 weeks. We should start to see liquidity coming, financial conditions coming, and equity starting to scream higher again. The big driver here is the PBOC. Right now, the PBOC have this cyclical pattern of every second half where they start injecting liquidity into the system. Additionally, we know they have a bigger cycle, much more like 2020, where they've got to deal with the debt deflation issues at home. So they're going to have to do quite a lot of easing, and they're going to do quantitative easing, and they're going to do all the liquidity measures necessary to drive their economy up. You see, without the Chinese economy, the global economy is a bit fucked. It's one of the key legs. So the Americans, the Europeans, the Japanese, everybody knows they need China on the game. And so China is now on the game doing what it's supposed to do. And we'd expect that to continue over time, particularly now that the yuan is starting to strengthen against the dollar, because the dollar's going down thanks to the Japanese. It allows the Chinese to be more aggressive, which everybody needed.
Raoul Pal's analysis provides a comprehensive overview of the current macroeconomic environment, emphasizing the importance of understanding the business cycle, financial conditions, and global liquidity in predicting future market movements. He argues that while there may be short-term concerns and fluctuations, the overall macro picture is supportive of higher asset prices, driven by central bank policies aimed at maintaining low interest rates and increasing liquidity. Raoul suggests that investors should focus on the broader trends rather than getting caught up in short-term volatility. The increasing liquidity and easing financial conditions are likely to continue driving markets higher, particularly in sectors like technology and cryptocurrencies. For those looking to navigate these uncertain times, understanding these macroeconomic forces will be crucial in making informed investment decisions. Please like and subscribe my channel.